Yeah, I'm part of BlueTree Allied Angels as well as BlueTree Venture Capital. We're a new VC fund. We transitioned from the angel world for the last 20 years into the venture world. And today we'll be talking about pitching to investors. And for those who have seen me in Professor Demler's class, I'll give you guys the same speech I give him in that class. I'm a relatively monotone speaker, so if you guys actually want to stay awake, I need you guys to ask questions, interrupt me where you want. This is hopefully relatively interactive and hopefully enjoyable. So please ask any questions. I'll stop every now and then and jump into it. So we'll jump through a few of these slides. Some of them are from some other presentations, but one of the first questions that often comes up is, what are investors really looking for? And you'll see kind of percentages up here. Ignore the percentages, pay attention to the order. First and foremost is management team. And you can basically throw that 30% out and say 100%. If the management team isn't someone we can get behind, the rest of it doesn't matter. We don't even get to the rest of it. The reason being, if we're investing in a company, we're going to be with you for probably the next 5 years as a Series A investor. As a seed investor, we're going to be with you for 7 to 10 years. I need to know that I'm going to be with someone who I can be with for those 7 to 10 years. When we talk to a lot of founders, the analogy I tend to use is, look, most marriages in the US last 7 years. We're going to be with you for longer than most marriages, and there's no way you can divorce us. So we have to be very sure about you, and you have to be very sure about us. After that, we can look at product, we can look at market, we can look at exit, financials, but that's going to be first and foremost. Now, when looking at the management team, what are we really assessing on? Every VC is going to tell you they're assessing on coachability, and every VC means something different by that word. For us, what we mean is we need you to listen to us, and we need you to be obstinate enough to fight against us when you really believe in something. And the reason for that is there are going to be a lot of shiny objects along the way, and I need to know that you're going to stick with your game plan unless you know that changing your game plan is beneficial for the long term, not because of a short-term peak like right now ChatGPT or LLMs or what was blockchain before that. I can't have you following trends and wasting money on that unless there's a long-term strategy behind it. So I need to know that you have enough solid belief that you're gonna fight me for what you believe in, but you'll still listen to me and take what I say with a grain of salt and use that to not change what you're gonna do, but evolve your thinking about what you're gonna do. Looking at the rest of the team, we often talk about diversity, and what we mean by diversity is we mean diversity of perspective. We want founders who come from different backgrounds, different educational backgrounds, different life backgrounds. Why is that? Because we need to make sure that all of our core team members are covering each other's blind spots. One, they have to come from different backgrounds. Two, they have to respect each other enough that they're going to listen to each other and they're going to feel comfortable arguing with each other. Because if those blind spots aren't addressed ahead of time, they're only going to lead to problems down the road. So that's what we're looking for. And we assess that by seeing how long has the team worked together. When we sit down with the team together and we ask a hard question, who jumps in? Who talks over whom? How do their conversations work together? Are they working as a team, or is everyone just letting one guy do all the talking and staying quiet, afraid to upset him or disagree with him? So that's what we're really looking for. Now, before we actually look at what we look at in the pitch deck, let's talk a little bit about what, as an investor, whether I'm an angel or a VC, whether I'm a valley or a coastal VC or a central VC, what am I looking for? My job is to get returns for my investors. Yes, I love investing in great companies and great people, but in the end, I'm giving you money. I get no dividends, I get no interest, I get nothing back until you sell the company in some way, shape, or form. So I need to know that I'm going to get there is some plan for me to get the return on my investment. Now, what we invest in are high risk businesses. These are high growth, high risk. They're either going to grow and exit, or they're going to burn out and fail. And general rule of thumb for us is about 60 to 80% of our investments, especially as angels or more coastal VCs, 60% are going to fail. That means the last 20 to 40% have to return the money we invested into all of those, plus give us 3 to 4x return on top of that, which means a lot of VCs are looking for companies that are going to give them 25 to 100x theoretically, knowing that if it's 25 to 100, it's never going to go above that, but it's more than likely going to come down from that number. And I need one or two that are going to really get close to that number for me to get a return on my fund that makes sense to my investors, so they'll invest in me again. And so how do we get that? We're looking for companies that have great financial models. So margins are relatively good. So we know we can sell the product for more than it costs us to make it. Large niche environments. And so this is one that often confuses entrepreneurs. Everyone likes to talk about a TAM. If I talk to a healthcare company, I will normally get a total addressable market of somewhere between 10 and 100 billion, sometimes a trillion. That makes no difference to me. I could care less about that. Why? Because that TAM, you're talking about the entire medical field. Your product is not owning the entirety of the medical field. Yes, medicine's a lot, there's lots of money in medicine. But if I'm creating a new stint, what I want to know is the entirety of the stint market, and then how much of that can you really get? Here we talk about a large niche market. Why is the word niche in there? Mostly because, let's go with the stint concept here for a second. There are major manufacturers of stents out there right now, Medtronic being one of the bigger ones. If you're going to go up against them and you're just going to say, I'm better than Medtronic at making stents, there are two major problems with that for me as an investor. One, I don't believe you. Two is, if that's true, Medtronic's going to do one of two things. They're just going to crush you by dropping their sales price until you can't sell for profit, or they'll buy you up cheaply by crushing you and then saying you either sell to us or don't. I don't want you going after a big 800-pound gorilla in against their main market. But if you tell me, look, we have a great stent for kids under the age of 3 for their heart valve. That's Pika Labs. That's one of our companies. That I can go into because I can look at that market and say, look, the reimbursements for those types of stents are so difficult compared to the risks involved that large companies are avoiding that niche. And so if you have a good solution that has the margins above that we were talking about, and you can make that business model work for you in such a way that it doesn't work for the large players in the market, that I can invest in because one, you'll survive and they're not going to come in and crush you. Two, if you really prove it out, they'll come in and buy you because they want access to that market. So that's what we're looking for when we're making these other decisions. That goes to the unfair competitive advantage. And go ahead.
I just want to make sure I'm understanding large niche market correctly. So, like you say that, you mean you want a market that's big, but just not quite as big as the market that your competitors are in?
So theoretically, what we want is a very large market that you're attacking a beachhead or niche piece of it well. And that niche has to be large enough that you can own that niche and it can be profitable for you to grow to get us the returns we want. And that there's a larger market that would want to consume you if you can prove that you own that niche. So think of, let's go back to Pika Labs, pediatric stents. Market size for that product by itself is maybe 100 million, of which they're attacking 10 million. And then if you take some of their other technologies, they can grow into other facets of it. Total market size for them, probably at a TAM, is maybe 300 or 400 million. At an obtainable market, a SOM, maybe it's 10 to 30 million. But given where we invested, that's profitable enough for us. And given that's the size of the market, there's reasons why bigger players would want to buy them. And so that works out for us because we can get our companies acquired at a profitable enough valuation that gets us the returns that we're looking for.
So would you say you're looking for firms that are more present within the fragmented market or more niche market than that? Because if you are gaining once you sell the company again later on in the future, after let's say 7 to 10 years, you want to be able to be in a market where there's other competitors that have the valuation enough, that have the balance sheet to buy you out.
Right.
So you'd rather be in a fragmented market, right?
Fragmented, it depends on what you mean by fragmented. So we want to be in a market where there are two or more large players. And the reason for that is if there's one large player, if they want to buy us, they can set whatever price they want. If there's two large players, you typically want to sell to the second or third place player. Why? Because they're the ones that are trying to overtake the first guy. The first guy already owns the market. So yes, fragmented. What we don't want is a market with 100 players in it where no one has achieved market dominance because none of them are really large enough to kind of own us. Mm-hmm. So yeah, so the question is would we evaluate a company differently if their strategy is IPO versus M&A? And the answer is yes. So if I'm looking at an M&A company, I'm looking at what is their unfair competitive advantage, who in the market wants to buy them, how much money is on those guys' balance sheets, and then how much value would this solution be to that company within their current product outline. If I'm looking at an IPO, I'm looking at how big can they grow, what are their margins, how much do they have to get to in sort of for them to be profitable, and then for them to be very profitable to justify an IPO at a valuation that gets me the type of returns that I need for my company.
Inherent in that is also a thought around the timeline or the timing it would take. Typically, if we're investing at A stage, Series A for us, an IPO would be a much longer play. So we, in our thesis and our selection, might discount an IPO play because it may not work out in, we're year 3 of our fund today. So, we have a limited window. Most VC funds are, time-centric, time-bound. So there's a limited window in which you want them to exit, and M&A exit is usually quicker, even if it's a lower valuation and it's achievable. Whereas an IPO could happen, it could be much larger returns, but it might fall out of that timeline, which does produce some complications in fund management as well. So a little bit of that as well.
That goes to another concept that as founders, you guys should think about, which is understand the limitations of your investors. If your investors in year 5 of their fund, they have likely 3 years. You have to be telling them you're going to exit in 3 years because more than likely, if you say 3, you're not going to exit for 5. And if you take 5 years, they're at the end of their fund. They're going to have to sell their ownership in your company at a fireside price. So they won't want to get involved in that. The bad side for you is someone's going to buy their shares who you've never met before, who's now going to be on your cap table and may have control of a board seat or other pieces of your company. And so you have to be very careful about who you're accepting money from. They might be great people, but you have to also look at where they are in their fund and what limitations they have in view of down the road what may or may not happen. And then understand if you're accepting, especially if you're accepting VC money, you now have a you now have a clock on you. And that clock, there is very little way for you to change the end of that clock. Once it hits, that fund has to do what they have to do. And it may or may not be in your best interest. Okay, so now we'll get to the kind of the key parts of this, and we'll work through our talk, but we'll talk about all the different parts of a pitch. But before we go through the pitch, I want 2 major concepts to think about as you're preparing your pitch and giving your pitch. One is remember your audience. Your audience is a set of investors. Almost every startup that we talk to talks to us about their technology and how great their technology is and their code is amazing. I'm an investor. Yes, I'm an engineer, but generally, I'm an investor. I don't know technology. That's not where I'm going to add value for your company. And if your investor asks to look at your code, run the other way because that's not where they're adding value. What you're looking for on my side is I'm looking at the finances, I'm looking at the business, I'm looking at the people, HR, legal. That's what matters to me. I want to know your customers are getting good satisfaction out of your product. How you do what you do should not matter to me so much as what are the results of what you do. Secondarily, understand the purpose of the pitch. You are not pitching to an investor to get money. You are pitching to an investor to get the next call. If an investor, especially a large investor, invests in you after the pitch, they don't know enough about you. Your job is not to try to convince them to invest in you today. Your job is to convince them that there's enough here that they want to spend some time getting to know you in order to take a much deeper dive into you, provide capital, but also provide their insights and access to their network and everything else because they believe in you. And so, yes, there are a lot of rules about pitching and slides and all this other stuff, but generally just remember why you're doing the pitch and to whom you're doing the pitch. So the thing in red up here, the 10-20-30 rule, that is not our rule. That is a general rule about pitching. Robert Kaczynski, I forget who has the 10-20-30 rule, but if you look it up on Google, you'll find it. But it's a good thing to remember. 10 slides, 20 minutes, 30-point font. Why? 10 slides, because I'm not going to remember much more. And if you give me a lot more slides than that, I'm just not going to remember any of it. 20 minutes because, and I'd say actually probably closer to 15 or less, because you don't want to be doing all of the talking. You want to get them talking back to you. Your pitch is really meant to entice them to ask you questions. 30-point font, because I don't want the people I'm pitching to reading my slides. I want them paying attention to me. If I have tons of words on my slides, while I'm standing up here and talking about how great my company is, they're going to be reading all of this information and ignoring what I'm saying. And that is not what you want. You can give them a deck with all of the verbiage in it ahead of time and let them read it or afterwards and let them read to their heart's content. But while you're there in front of them, you want them engaged with you. And so we'll go through all of this, but that's the big kind of takeaway from this is the whole point of the pitch is to get them to get engaged with you, really buy into you as a team. Then the rest of this all matters. Any questions about just generally the pitch before we get into kind of what should be in the specific slides or why these slides matter? Okay, so the opening slide. You generally don't put a whole lot of effort in this one. It's not hugely worrisome. The one thing that a lot of companies miss is they try to hide the ball. Let me give you my entire pitch, and at the very end, I'll tell you what I'm asking for and why I need the money. The problem is that as an investor, I need to know how much money you're asking for and why, so that I can put the rest of the pitch into context. I know what you're going to do. So when you tell me what the problem is and what the solution is and how big the market is, I can take the money you're asking for and understand what you're going to do with it in order to address those problems. You don't need, this isn't a story that has to build up to a climax, and you're not writing a book here. You need to tell everything up front so that I know how to make the most use of the information you're going to provide me as an investor. And so, yeah, cut to the chase. Don't worry. This isn't something where you need to kind of hide the ball on us and, try to make it all snazzy and everything. That's not what's going to convince me to invest my money in you. The thing is if I know what you're doing, I believe in what you're doing, and I know that you're going to be a good shepherd of my money in doing it. So a lot of founders love to talk about their solution. What is the technology? How am I using ChatGPT? How am I doing something cool that no one has ever done before? Forget all of that to begin with. First thing I need to know is, what is the problem you're trying to solve? Is someone willing to pay to have that problem solved? You might have the greatest solution for a problem that no one wants to pay for. That's not something I want to invest in. I want to know who's feeling the pain. Why are they feeling the pain? What are they doing right now? And why is that not solving their pain? What is this pain? More importantly, I want to know that you're truly connected to this pain. What is your personal experience dealing with this pain? If you're talking to me about building a new surgical tool and you've never done surgery or you've never been in surgery, that's hard for me. But if you can say, look, I was a surgeon and this was a problem I dealt with every day, and it was killing me that I couldn't do it more elegantly or more efficiently, I can get behind that because you know the problem, you know what your potential clients are going to be looking for. You can speak their language to them. So it's not just that there's a good problem. I need to know that you personally are connected to that problem. And I need to know why. Like when the going gets tough, and this will get tough. I've never seen any company where it's just been, roses the entire time we've invested in them. This gets tough. There are going to be times you're going to want to quit. I need to know that you're so connected to this problem that when that happens, you have a reason to stick to solving this problem beyond, oh, I'm looking to be a CEO, or beyond, oh, I want to be rich. I want to know that you really want to solve this problem. And that builds into the solution. I need to know not only that there's a problem, we just talked about that. I need to know philosophically, how are you attacking the problem that's different than the rest of the world? If you're telling me you're attacking the problem that everyone else knows about in the same way everyone else is doing it, and somehow you're going to succeed, that's hard for me. But if you say, okay, we'll go with augment therapy. Augment therapy is this idea that when people have diseases or are hurt, they need to do physical therapy to get better. It's just been shown the more physical therapy people actually do, the faster they recover. The problem is people hate physical therapy. No one wants to do this 10 times in a row. They just don't like doing it, and so they don't do it. So what does augment therapy do? They turn it into a game. So rather than doing this, you're dancing with pirates or you're flying through a virtual world. But the movements are physical therapy, and so you do the physical therapy, but you don't know you're doing it. And by that, they can show that people are actually getting better faster, more efficiently, blah, blah, blah. So they're attacking a known problem in a new way. That is something that we get interested in. That's what gets us excited.
I just have a question. You said that typically there's a lot of conversations before getting to actually pitch. So how much do you know about the founders and pain points prior to actually getting to the point of pitch?
Sometimes a lot. So the question is prior to an investor coming to a pitch, how much do they know about the founder and the company that's about to pitch to them? Sometimes not that much. It depends on how it came to us. So, and this is true for us and true for most investors that I know of, which is I'm going to put more effort into those companies that come to me through a trusted source than I will to those companies that come to me out of the blue. So if you come to me out of the blue, more than likely your pitch is going to be the first time I'm really taking a serious look at your company. If you're coming through me to another investor I've worked with before, an accelerator, an incubator that I know and that knows me and is known to do good matching, then I'm more likely to have dig through this, probably ask them about you, what has been their experience. And so I'll probably have a little bit more knowledge about the founders and about the company for those that come to me through trusted sources.
Actually, ironically enough, a lot of times if it's a cold or out of the blue pitch deck that's shared or an introduction that's made and I don't know anything about it, before the first meeting, I don't actually do a lot of research because I don't want to start narrowing my, finding the right opportunity. Let the person pitching, usually the founder or the CEO, speak to where their strengths are and where their weaknesses are. And then following the call, if it's of interest, then we'll dig in and start, some version of a pseudo diligence process. But I try not to know much about it. It's out of the blue. If it's usually through reference, like Sri said, we usually might have a conversation with a person who is referred it or connected us, or likely what I've seen is they'll send a summary of why they like this idea when they're making the introduction in the first place. So that gets you started on a leg. It also I think depends on the type of investor you're pitching to. So we are generalists or mostly industry agnostic, although we're software enabled tech only. So there's quite a bit to know because there are quite a few markets, quite a few types of technology stacks and how they fit in the problem spaces. But if you're building in a particular space and you're pitching to an investor who invests in that space, there's a high chance they've done enough diligence or cycles where they've heard market sizing from other pitches or the problem statement that you're working with other pitches, and will probably be far more informed, even if it's the first time you're making the conversation from your end, right, pitching. So it's a little bit all over the place, I think, that way.
And this is the slide that most often gets founders in trouble. Because of that third bullet, they start to jump into to how they solve the problem, not why they solve the problem. I don't need to know what the technology is. I don't need to see a tech stack. I don't need to see a flow chart of how you're solving the problem. That isn't as important as to what's your philosophy around this? How are you doing this differently? What's the niche you're going after? I'm looking more at a business level. And here's the key point about that. Whatever technology you're using today to solve this problem will be different a year from now and different 2 years from now. I can't make an investment based purely on the technology. In fact, almost never do we make any investment based on the technology, because technology moves so quickly. We want to know philosophically, are you attacking a niche that really allows you to succeed where others have failed? So for those of you who have taken Professor Taylor's class, at one point in his class, he'll talk about the 3 questions he tends to ask. And I like this, the way he phrases it. Why you, why now, why this? Why are you the right team to solve this problem? Why is now the right time to solve this problem in this way? Why is this the right solution in view of what's already out there to solve this niche problem in a way that's going to allow you to succeed where others have failed? Next goes to the business model. And this one seems like it's an easy one, but this is one of the ones where you can make or break a pitch. And the reason I say that is you have to know who's actually writing the check to your company. So for example, one of the mistakes we made with the augment therapy company I was just telling you about was not realizing that while the person who is hurt is the one doing the physical therapy, the person who's paying us is their insurance company. And so we had to address a different pain in order to get the insurance companies to buy into the product. If you don't know who's paying you, your business model won't make sense. How are you going to get to them? So we invested in another company called Aeronix, and there's a long story behind that one, but eventually the company builds oxygen for pets. Great. How do you sell to veterinarians? You do not sell to veterinarians. You sell to distributors who sell to veterinarians. So now you have to create a different model to entice the distributors to sell your product over other people's products. So you have to understand how it is. And then finally is gross margin. And gross margin is an interesting one because it changes at scale, which is great, but you're not at scale yet. And so your gross margins are not going to look good. So you have to have a good story about how your fixed COGS versus your variable COGS are correctly stacked such that as you grow the company, your margins look more appropriately and you get profitable relatively quickly. So understanding those pieces of your business is very important. It's important to get validation at this stage. The last bullet here talks about dropping names of companies that are investigating you. That's one way to do it. Another way to do it is just to talk about who else has built a business model like this so that you can put your head, as an investor, I can put my head around what is this going to look like over time and what does it need to look like? This also helps me figure out if the ask that you've made makes sense in terms of how you're going to get to the ability to make actual money. And so that's that one. And so I know I've been jumping through these slides relatively quickly, so I'll take a little bit of a break here. I probably should have on the last slide, but any questions? Okay, we'll keep going. So under the underlying measure, or what we call your unfair competitive advantage, you have to have something that's going to allow you to succeed out there. And the reason for this is the one thing we absolutely hate to hear is that no one is solving this problem or we have no competitors. That means so it sounds great from an entrepreneur side of the table. From an investor side of the table, that tells me one of two things. Either you're not solving a problem anyone cares about, or you're solving a problem that everyone else has figured out is so hard that they're not willing to even touch it. And both of those answers scare me to no end. I don't mind if you're solving a problem in a different way, but if you're telling me that there's no competitors, then I really have to ask why. So and we'll dig into that piece a little bit different. Now, if you know there are competitors out there, what is it that makes you different from them? Some of it's, oh, go ahead.
Just a question. So, let's say you identify some pain points and your competitors are attacking specific pain points and your solution is to actually combine some of the workflow. What's your initial reaction? Is it, no, that doesn't seem to work, or like, does that make you wary?
It doesn't make me worry. It just makes me wonder about the previous slide, business model. So here, what I need to understand is why has someone not aggregated different solutions to do what you're doing, since that's what you're kind of suggesting. If I believe in what you're saying, and you could say, for example, right now, with the amount of processing power that's out there and available, and the amount of data that's out there and available, at this point in history is the first time that people that companies could develop a software solution that enable us to do these three steps all at one time without needing three different companies to do it. And that's how we're going to do it. And by doing it in that way, we're going to add efficiencies in here that allow us to be profitable. That is a great solution. Again, the question isn't so much what you're doing, but why are you doing it? And why is now the right time? Like, why hasn't someone done it in the past? So that doesn't scare me away. It just makes me change the type of questions I ask. So when we talk about secret sauce, most people think technologically, what is my secret technology? But it can be, how do you get customers? It can be culturally, how do we present ourselves to the world? It can be a lot of different ways. What we're really asking you is, what differentiates you from your competition out there? And why is that going to make someone more likely to buy your product than someone else's product? And then, most importantly, if you've got good answers to those two questions, how do you maintain that over time? Like, more than likely, if you've done it and you prove those two out, you're going to have other people copying you. So what do you do to protect yourself? Is it first mover advantage? Is it patents? And if it's patents, then we have another whole topic to talk about that. Is it secrets? We have a secret way of doing certain things, manufacturing or whatnot, that allows us to be more efficient that no one else can reverse engineer. So those are what we're really looking for. These types of things are really, really most easily explained through pictures. And here, truly, pictures are worth 1,000 words. As much as you can explain it, if you can show it to me, and I hate making this recommendation, but I'm going to anyways. If you have a video that is clear, concise, and works 100% of the time, it might be a little bit of a better way of showing kind of what it is. The reason I hate that recommendation is because videos are never clear. They never work 100% of the time. So avoid them, but this is one place where if you have a good one, it kind of makes sense. But pictures, diagrams, flowcharts, now is the time for that. Not about your technology, but about why you're special. A few caveats to this. When I say what makes you special, I do not mean tell me your secret sauce. I mean, tell me about your secret sauce. Do not give away trade secrets. If an investor asks you about your trade secrets, do not give away trade secrets. If they really push on you, let them know, if I were to tell you our secret, how do you know I haven't told other investors our secret, those who didn't invest in us? It is our job to protect it. I can tell you the outcome. I can tell you philosophically why we did it. I just can't tell you what it is that allows us to do it. And they should not ask. They shouldn't really need to know. It's not an investor. If I really need to know if you are doing what you say you're doing, I'll talk to your customers and they'll either tell me we love the product or we don't. Marketing and sales, this is more for later stage companies, but it's good to think about early stage, but understand what you're doing as a seed company is really hypothesizing about what is going to work. What you're doing as a Series A is talking about what has worked and moving forward. B, C, and D is more about, okay, let's just put more money into what is already working. The harder part about this one is to understand from an investor's perspective, marketing and to an extent sales are hugely resource draining. Marketing, if not done well, can be hard. And so you have to really understand what it is you're trying to achieve. If you're trying to tell me that you're going to put out a marketing campaign so that everyone knows about your product, I'm going to walk in the other direction because that's not a realistic goal for the amount of money you're going to have access to. Now, if you're telling me you're going to market to this specific niche, these 1,000 people to see what kind of marketing spend works or how much your adoption is, that I can work with. That works for me. Or we're going to put together an article for this trade journal and we know how much it's going to cost to do the research and put it out there. That I can get behind. But be cautious about being overly optimistic about marketing and especially sales. Go ahead.
If I want to develop better intuition for go-to-market strategies and what might apply best to my startup, are there any resources you recommend?
None that I can think of off the top of my head, other than talk about your startup, ask people about your startup, go out and just talk to people. So one of the big things, and you'll hear about this in the Swartz Center, you'll hear about this in Project Olympus or Innovation Works or anywhere, almost every accelerator and incubator is going to tell you something along the same lines, which is go out to where your buying public is and talk to them. If you haven't talked to your actual clients and you're just hypothesizing about what may or may not sell to them, you're doing yourself a disservice because you're not talking to the right people. Now, once you've done that, there are lots of books about this sales process or that sales process or this marketing or that marketing. And you can almost find any book to justify anything you decide to do. It is more of a, whatever you do, know why you're doing it. Be very clear about what types of returns you want to see in order to continue doing it. Most people who do sales or marketing go out there and say, okay, here's our sales process, we're going to go and do it. And they never think about, okay, how many sales do I need to land in order to prove that what I'm doing has been effective? And so when they land their first sale, they're like, this is working. When maybe this is working. When maybe they should have landed 5 or 6, or they should have changed their strategy, but they didn't know what metric to measure themselves against. And so anything looked like success at that time. So it's more understanding what is the ROI you're trying to achieve. If you achieve it, that's great, understand why. If you don't achieve it, that's also great, understand why. It may be that your goals were incorrect. It may be that the marketing isn't working. Either one could be happening, but you want to learn from them both. Generally, for all of entrepreneurship, and this is something you're going to want to bring up in the pitch without bringing up in the pitch, is a lot of entrepreneurship is about failure and how do you handle failure? Do you turn away and go the other direction, or do you sit there, learn about it, evolve what you did, and try again? A lot of entrepreneurship is about banging your head against the wall enough times to break through that wall. And so we need to know that you're going to be persistent enough to do that, while also learning from your mistakes and not just repeating the same thing over and over again, just to bang your head against the wall. We want to see growth, but we don't want to see you turn away too quickly. We talked about the competition slide a little bit earlier. Understand competition is not a good thing. It's not a bad thing. It is just a thing. Your job is to understand what the competitive landscape out there looks like, how you fit in that competitive landscape, and why this is important to you. So there might be a lot of clients you do not want to go after because there are other competitors, so to speak, who are better positioned to take those clients. So you're not out here to pitch to every client, and everyone who comes to you for your solution may not be a good client for you. You have to know who is your ideal customer and focus on them, and be willing to send your non-ideal customers to your competition saying, you're not the right one for us, but here's someone else who might be. Rather than trying to land people who are outside your ideal customer. And why is that so important? Because you don't have money to waste trying to convince someone to buy your product, and then more money to waste trying to make your product what they want. You, especially as an early stage company, need to find the clients that really want what you're selling. Then you can start expanding. But if you try to be everything to everyone, you will not succeed in this early stage startup world. We talked about the management team. It is the most important thing about the company. And you need to understand kind of the roles of everyone. And you need to understand when you take money from an investor, you are suddenly bringing in someone else onto your management team who may or may not be your boss in certain situations. And that's all right. You just have to understand that that's what you're bringing in when you bring in investors. And different sized investors, different types of investors are going to act different ways about this. Some investors are going to be hands off. Here's the money. Tell me when you're going to return my money back to me and I'll come in and talk to you about it. Some are going to be very hands on. Here's the money. I want to be in your daily management meetings every day for the next 2 years. And some are going to be in between those. And you have to know what it is you're looking for, what it is your company needs, and who makes sense. Not all money is created equal. And understand, you have to know yourself very, very, very well. What are you really good at? What do you really love to do? When is it that you might decide, I no longer, let's assume you're the CEO, I no longer want to be the CEO of this company. I want to be head of strategy. I want someone else to manage AR and AP and marketing. I don't care about those things. I want to be product development. Know yourself to understand that. One of the questions we asked a lot of our founders is, when am I going to fire you? You're the CEO right now. When am I going to fire you? What does the company have to do in terms of business growth for you to say, it is time for me to move to a different job and someone else to come on to the CEO? And then we'll ask them the same thing. When are you going to fire me? I'm sitting on your board right now. When am I no longer valuable enough to you to justify a board seat? What does that look like? This is much more of a partnership than just to me giving you money and you talking to me every quarter about what's going on with the company. If you're only looking for that, you're giving up some of the hardest stuff to get back in your company, your equity, and you're not getting enough out of it. You're getting a few dollars that you'll spend, and then you'll no longer have the money and you still won't have the equity. So don't give up the equity unless you're getting enough in return to justify giving up that for the rest of the life of the company. Any questions about that before I move on? And just in case I'm boring anyone, we're coming to the end, so no worries there. But this is a relatively important point. And so the next point is about your financials. And what is it you're trying to do? So oftentimes we have companies who come to tell us, here's the size of the market. Next year, we'll own 1% of the market, then we'll own 5%, and then we'll own 10%. Based on those numbers, here's what our revenue will be. That doesn't really work, because that's not matching to anything. That's not telling me, how are you going to get that revenue? How many sales do you need to do to get that revenue? Who else are you going to be pushing out to get that revenue? What we tend to like to see is more of a bottom-up forecast that then is justified by the top-down forecast. So the top-down is what I just talked about, that kind of percentage based on total market size. That is great to say, it's very unlikely we'll exceed these numbers over time. But the bottom-up forecast really tells me, how do you intend to get to those sales? How many salespeople? How much marketing spend? How much organic growth? What's your churn? How much is your contracts growing month over month? What's your NRR? What's your ROI? Like, those are the numbers that I need to see to understand year over year, month over month, how you're growing to get to where you're going to go. This is also one of the ones where it's more important for me to understand what your assumptions are on how you build that model than what your numbers say. Almost, if not every company that has ever pitched to me has never gotten this right, and not even close. Most times, if I look at their revenue 2 or 3 years down the road, it is 1/5 to 1/10 what they predicted. Almost never do companies hit anywhere close to what they're projecting here. And that's all right, I don't care. But I need to know the assumptions. What kind of sales do you need to hit? What is your organic growth? How much marketing is going to lead to what? So that when we're working with you over the years, we can start to work within those assumptions to figure out where to put more money, where to pull back money, how to make strategic decisions. Any questions about the financials, but when pitching in a relatively short amount of time? Exit strategy, and this is one that is hit or miss. And so for us, for BlueTree, this is where I start. Like, this is, we always say we begin with the end in mind. Exit is one of my, Ani will tell you, something I talk about all the time. I am really focused on exit. Not all VCs, most VCs are not to that extent. And that's fine. So it's great for me to work with VCs who are not so exit focused, because they're focused on other things, customer success, so we can all work together. What I need to know, and what most VCs would want to know, and how you can really differentiate yourselves from other companies that are pitching to them, is I want to know who's going to buy you. I want to know why they're going to buy you. I want to know what they're hoping strategically to get out of such an acquisition. And then what are the KPIs that you need to hit in order to justify a valuation that makes sense to me? So almost always everyone goes to revenue. Okay, in my industry, the revenue multiple is 5. I need to get my revenue up to 25 million to get to $125 million exit. That's my exit strategy. That's not an exit strategy. That's a hope. The fact is, maybe you will be valued based off of a multiple, and maybe that multiple will require your revenue to be X to be bought at that valuation. But before we get to that point with any acquirer, they have to have some other reason for buying you. They're not just buying you because the revenue multiple says that they should buy you. Most buyers, unless you're talking about PE or financial buyers, most buyers are looking to buy you for a strategic reason. So what does your product do to help them sell more of their product? What does your product do to help them increase their average contract value for all of their clients? What does your product do to open up new markets for them? Why strategically do they want to buy you? That's one. And then we talked about this a little bit earlier in a different context, but who would buy you in your various markets that you're looking at? How much cash do they have on hand? Hopefully, the people who you're talking about buying you are likely going to be publicly traded companies. Go look at their cash balance. Look at their revenue. Do they have enough money on their books to justify an acquisition of this size? If not, and if there's no one else in that category, maybe that's not a valid exit for you to be pitching, because that's what we'll be analyzing as well. Going to the question about IPO, look at what are the multiples for IPO. How profitable do you have to be? Understand from my perspective, if you're pitching me an IPO in X years, I have a hold period. I have to hold my shares in your company for another year. which means I want to make sure that you are exiting at a time where you're so financially viable that you can hold or increase that share price for an entire year so that you can hold it for when I can sell my shares. And by the way, as a founder, you are also stuck with that. So you want that as well. And so I have to understand, what are the business metrics? What are your margins? What are your net income? What's your EBITDA? What's your, overall profit that's going to justify an IPO of a certain size that's going to get me the share price I need to sell my shares at the proper price. Go ahead, Elsa.
Leave it on the- Can you briefly discuss the reasons BlueTree has moved away from medtech/biotech?
Yeah, so the question is why have we as BlueTree moved away from medtech and biotech? We used to be a little bit of everything. So I have Peptologics, which is a therapeutic. We have Cytoagents, which is a therapeutic. Pika Labs, which is a medical device. In our angel portfolio, when we moved to the venture world, we dropped all of that and we went pure software all over, but always software. Why? A few different reasons. First and foremost is medtech takes a lot of time and a lot of money. If you're talking about a therapeutic, I don't get to sell my first pill until I've done my proof of concept, my IDE submission to the FDA. I've done clinical phase 1, A and B, phase 2, A and B, phase 3 trials. I've proved out a commercialization plan, and then possibly I'm allowed to go to actually sell the product. There's a lot of risk involved. There's a lot of money that's involved to get through all of that. And there's a lot of time involved, anywhere between 10 and 15 years. If I'm doing a medical device, again, I have to go through the FDA. If I'm doing something that's very new, I need to file a de novo submission, which means I have to get enough clinical data to convince the FDA that this hasn't been done before and it's still safe. If it's a 510K, which means that I'm following someone else who's already done that de novo, that's a little bit easier. But I have to know those things. I have to get the FDA to approve it. Everyone thinks the FDA approves quickly. They do not. You will submit 2, 3, 4 times. It'll take years to get through the FDA. Until that time, I cannot sell my product. That means that any revenue projections you have are likely blown unless you can get through the FDA. So in view of that, there's lots of success. There's lots of ability to make lots of money in therapeutics and medical devices, but you need a lot of time. And so for that reason, we've kind of gotten away from that.
Are you worried about dilution in that case because of the amount of money that's needed?
So the question is, are we worried about dilution? And the answer is yes and no. And I'll put this in terms of, so I don't worry about dilution. I worry about share price. As long as the share price is going up, I don't care about dilution because my value is going up and it's going up at the rate I need it to go. What I really worry about is when the price per share stays flat and I get diluted, which means there's now more capital above me in the waterfall and I haven't seen an increase. So almost by definition, the product is not doing well. So that's when it scares me. But for example, one of the companies I mentioned is Peptologics. We invested when it was still in Pitt. And when it came right out of Pitt. And so when we invested when it was a $3 million company, 2 rounds ago, Peter Thiel and 3 rounds ago, Peter Thiel invested and we got diluted. 2 rounds ago, Peter Thiel brought in another large investor who put 50 million in the company. We got very, very diluted. It is still growing and hopefully going to an exit. We invested at 19.5 cents per share. The last round was at about $2. This next round is at about $4. I'm not worried about dilution there at all. That's not what scares me. I don't mind. And the reason I don't mind is all those other investors who came in added a lot of value. They brought in therapeutic teams. They brought in FDA teams. They brought in scientists. They brought in CMOs that really helped this company grow. Things we couldn't have done as BlueTree. So dilution doesn't scare me, but share price does.
How much say do you have in, let's say, firms are looking for further investments? and in order to even avoid that dilution to a certain point, how much say do you guys have? Like, or is that mostly dependent on the CEO, the founder of the firm?
So any future round of the investment into the company okay, let me reset that for a second. If the round that we invested in used NVCA, which is the National Venture Capital Association terms, if they're using very vanilla terms, which you all should be using, there is a portion of that that basically says the company is not allowed to raise any other money or give away any equity unless approved by the board, and specifically also approved by the investor shareholder board members. So we do have an ability to control how much money comes into the company. More often than not, you will see us agree to it. The only things we might change is this might not be the right lead investor, this might not be the right amount, things like that. But we want this company to grow and we want this company to exit. And to do that, we all understand we're going to get diluted. So as long as you're building value and you're raising money for a rational reason that will continue to build value in the company, we're all for that. In fact, hopefully the investors you have are helping you raise more money, not stopping you from raising more money. Make sense? The other thing about exits, and the hard part to think about exits, is everyone thinks that, okay, an exit happens. It doesn't. An exit has a process that builds up to the actual exit event, and then another typically 2 years of stuff that happens after the exit. Earnouts, escrow payments, different things happen throughout. So it's not just one event. This matters for us as investors. This matters more for you as founders. Why? Because more than likely, part of the exit is we're going to put some golden handcuffs on you. You stay with the company for the next 2 years and you get X amount payout. That sounds great, except that you have to stay there for 2 years while they basically destroy your company and you have no say in it. And they don't mean to destroy it, and they more than likely aren't going to destroy it, but they're going to not run it the way you would want to run it, because you will be taken out of the leadership position, but they still want you to be there because you have all the intellectual property and the insights of the business. And so it's a hard position to be in, especially when a lot of your net worth might still be tied in waiting those 2 years out. So part of the exit strategy is also for us to make sure you as founders understand what this might mean for you down the road, in a lot of different scenarios. So we talked a lot about some of the mistakes and some of the advice. Lack of preparation is a big one. A lot of people pitch to us having not pitched before, or more importantly, having pitched before and not listened to what the crowd told them. We've had pitches where you would ask one question and the answer would last 3 or 4 minutes. They weren't reading their room. Like, we had a very specific question about a very specific topic. And even when, after the second time that happened, after the second question, we said, give us a 3-word answer to this question. And it ended up being another 3-minute answer. Listen, be prepared, be concise. Don't feel like you have to fill up time. What you wanted. So if I'm asking you a question, I'm not trying to quiz you. I'm not trying to test you. I'm not giving you a grade. There is something I want to know. And I'm asking you because it's going to change my investment decision in one way or another. And so all you need to do is figure out what it is that you think I need to know, and let me know it. And if it's not, I'll clarify. That's all right. I don't mind. It's not a problem. It should be more conversational anyways. We said the 10, 20, 30 rule at the very beginning of this. And you're like, well, how about this other stuff I want to present? Throw it in the backup slides. Backup slides are great. If I throw a question at you and you have a backup slide ready to go that answers my question, I'm thrilled. Why? Because it shows me that you're prepared for more than just giving a pitch. It shows me that you actually thought ahead about what I could be confused about and had prepared stuff in order to address that confusion. that lets me know how you're going to run your company as well. That you're going to think about things strategically and be prepared for things not to go the way you expect them to go. All of this pitch, the diligence we put you through, all of that is us assessing how well do we think you can run a company, not this company, just how well are you going to run a company. That's really all we have for today. Would love to take any questions you guys have. If I wasn't clear about anything, happy to talk about really anything related to pitching to investors. Go ahead.
After you receive a pitch, let's assume it's a warm type of intro from a trusted accelerator of sorts. What is that debrief like internally? Right, we're all people, we have a meeting and then you have to recap with your team afterwards. What is that process immediately following what a pitch is like?
That's on you.
Oh, yeah. Yeah, so immediately process, a couple of steps that will likely happen is usually someone who's hearing the pitch will make a summary of notes. It's going to go into a CRM system or some record that they have interacted with a founder or a company, and that's going to be permanent. One of the things that in advice wasn't written, though it's part and parcel of pitches, be honest, right? Like a lot of times we hear some pitches, I mean, less, I think now it's Series A, where like things are kind of made up in the pitch and there's exaggeration. All of that's kind of going in some notes. So that really happens pretty much immediately. For us, we wait till our weekly meeting to then bring forward, if the deal is good, which is to say it matches our thesis, it's kind of screened through, then we'll actually present it. If it's, if I found red flags during the pitch, or if something was a mismatch, like, oh, it was going to be a software company, but when we heard the pitch, we realized it's a big hardware component, for example, and it doesn't fit our investment thesis, then I'll probably just give a very short summary in our internal meeting and say, I talked to so-and-so, logged it. If I'm very impressed or compelled by the pitch themselves, we might introduce that founder or that company to other investors. If not, then we'll probably have a nice little thank you for pitching to us email after the meeting. But really what we're doing is summarizing risks and what we really loved about the idea. Particularly in the risks are two types: risk in the business model or in the product or in the solution or in the company in general, but also from a diligence angle, risk of what we don't really know. So, like I said, we're generalists, so we've got a lot of software plays that come along. Technology is always evolving. So if we hear like a new type of business model, new type of solution, it looks interesting, it kind of matches our thesis, but we don't really know. We also talk about what effort would be taken in diligence as well, in order to go from the first pitch to subsequent discussions. And usually subsequent discussions are due diligence focused. So we're really at that first summary deciding whether we're going to proceed with talking further with the founder or other investors in the round, or go down our diligence path, or we're going to kill that process after that first conversation. Is that fair?
Yeah. And I would say, the be honest thing is very important. Look, as an investor, and every investor that I know of, none of us expect the companies pitching to us to be perfect. In fact, if they were, they wouldn't need to pitch to us because they'd already be, ongoing concern. We don't need that. What we need to do is we need to understand risk, and how much of that risk do we think we can mitigate with our team or with the other investors that we know, and how much of that risk is just not appropriate for us. So for example, we really call ourselves Midwest Capital or Pittsburgh Capital. We're not looking for high risk, high return. We're not looking for 100x. That's not how our firm is built. But if someone comes to us and says they have figured out a new way of doing quantum computing that doesn't require it to be held at like 2 or 3 degrees Kelvin and can be done at room temperature, and it's a likely, someone out of a material science department here at CMU, I would say that's great. That's not for us, but I know Future Capital in California, and I'd love to introduce you to them, because that's more, if I believe in them and if I'm willing to put my reputation at risk for you. So your job, even if you're not a perfect fit for us, if you've convinced me enough that I'm willing to put my reputation on the line, I'll introduce you to other investors that I think might be a better fit for what you're doing. Generally, if you're introduced to us through a trusted connection, I will give you, depending on what our relationship is, a more generic feedback of why we passed. And it's going to be relatively light, and there's a reason behind that. for a lot of different reasons, I'm not looking for pushback. If we've made a decision, we've made a decision. I might give more feedback to the person who introduced us so they can correlate it with other feedback they're getting and provide the appropriate feedback to you. If it is something that we're interested in, then you enter the diligence, and that's in our process where you're going to get weekly emails from us asking you for a set of information as we try to, what we tend to follow is how quickly can we get to telling you no? So every week we'll send you a set of questions that if the answers aren't what we need, we'll say no. And if you get through enough of those, then the answer is yes. As you go through the process with BlueTree, and I've seen this with some others now, everything for us, we always identify a resident skeptic. Someone in our team, likely the person who brought you to the entire team, is going to be a champion. Someone else on the team is going to be a resident skeptic, and their job is to test all of the assumptions and not buy into it, so that we always have someone who's playing devil's advocate. So the process is not fast, but hopefully it's informative to us because we're asking the questions. Hopefully it's also informative to you about how working with us is going to feel like in the future.
Do want to reiterate though that this is post the pitch stage.
Yes.
This is when we're actually in conversations with the team or with the founder and going down a structured diligence process. So it's not about the presentation on the 10 slides and the voiceover of the voice story at this stage.
And you should know as much as you can find out about the investors you're pitching to. This isn't a numbers game where you're trying to pitch to 100 or 1,000 investors. If you pitch to 1,000 and get one, I'd rather see you pitch to 10 and get two. Especially because if you are only pitching to 10 and you're targeting it, hopefully those 10 are more aligned with you philosophically. And if you're like, for BlueTree, if you really want to know about us, ask around. People will tell you, we are slow. We write small checks for the amount of diligence we do. We are very involved in the company once we invest. That is who we are. You can ask around. People will tell you all sorts of things about Catherine and myself and Ani and Lindsay. If you want to know the type of people we are, we don't hide it. And you should do that. I don't want to hide it. I want you to know who we are, because it is much better for me as an investor if you know what you're getting into beforehand.
Mm-hmm.
Yeah.
Let's say you've done a lot of the research and identified, 10, 20 investors that you want to pitch, and you start coming up with a plan to get your first round of funding. How much time or what rules of thumb do you recommend for the rest of the amount of time that it takes to get
6 months.
6 months. Maybe?
Yep. Typical from start of actually pitching to closing the round, estimate it's going to take around 6 months. It may take a little bit longer than that. And there's a lot of different reasons for it, but the process, everyone thinks it's going to go fast and you get your first few yeses, but closing out the last 10, 15% of a round takes a lot of time. And a lot of pitches at that point. So expect it to take some time. Especially ways to speed that up is finding the right investors up front. If you find a good lead up front who's well connected with other investors and who's willing to take you and kind of co-pitch your company to people they trust, then the round can get closed a little bit faster because more people will be pulled in writing checks in order to fill out the round. The other thing that happens typically with your lead investor, and sometimes with the second largest investor, is we'll push you back on how much are you raising and why. Almost always, I can say, the companies that have come to us have asked for too little money because they've built a plan assuming every block goes according to plan, and they've left no buffer in case things don't go the way they expected it to go. The problem with this is you've built a plan that I need to know what metrics you need to hit to get a valuation jump. And you said, okay, I've got a plan. I need to do X, Y, and Z to get a valuation jump. Here's the money it's going to take. If something happens and it takes more money and you don't have the money to do it, and you don't do X, Y, and Z, the next round is flat or even down round, or suddenly I'm at risk. So I'm going to want to see, okay, how much of a buffer is built in there? And I don't want just a buffer. I want to know, okay, let's assume you do pull it off. What can you do with this extra money to increase the value even more? you guys, I want the people who are pitching to me to think strategically about every decision that they're putting in front of me.
So say, sorry,
Mhm.
question, but, you're thinking, when I hear that, I basically assume that we need to come up with a contingency plan or a contingency percentage or some way to, hey, this is the best case scenario, this is the likely scenario, this is the worst case scenario, and from there, we're basically using that amount of money to pat ourselves just in case.
Yeah, so typically what we have our companies do is basically a first close and a final close. Basically, minimum amount of money to actually hit the goals is your first close. I'm not gonna take $1 until I've got that much committed, because anything less than that, and I'm not gonna be able to reach the goal. It makes no sense to take money if I can't actually do what I said I'm gonna do. Then we have up to a final amount that they're allowed to take in. This is that buffer and what we can do with that money, should we not need all of it to get to the goals that we set.